All right, I'm going to go ahead and do a brief presentation on selling short, what it is, how it's done, the mechanics, and essentially just touch down on the basics of selling short. As we know, the Dow, S&P, NASDAQ, they've all been reaching all-time highs. We're looking at unprecedented levels we've never seen historically. Now, a lot of people think that we're due for a pullback, and I'm not giving advice or my sentiments on the market as a whole. But in case the market does have some sort of major correction or something of that nature, you want to be aware of some of the products and tools that you can utilize to kind of protect yourself from that or even potentially capitalize on that, which brings us into selling short. So what it is and how it is done. The first thing, you want to familiarize yourself with the concept of bullish versus bearish. Bullish means that you anticipate that a stock's price will rise. Bearish means that you anticipate that a stock's price will fall. These are just some market terms that you want to familiarize yourself with. I'm sure some of you advanced people, you already know about this, but want to make sure that I cater to the beginner with this particular video. So just bear with me. Now, the purpose of selling short. The basic purpose of selling short is to capitalize on your bearish sentiment towards a stock. Now, you can use it in different circumstances if you want to kind of have some sort of hedge or some sort of protection on a different position. But in essence, that's what it is. It's going to allow you to capitalize on your bearish sentiment towards a stock. The requirements to sell short. In order to sell short, you will need to open a margin account with a brokerage firm. The minimum to utilize margin is $2,000. So you're going to need at least $2,000 in cash or marginable securities in order to sell short. Selling short is also not permitted in retirement accounts. I'm not exactly sure why, but you're not going to be able to sell short in your IRA, your 401k. I think some of the logic is that because the strategy can be a little more risky, it also requires margin, and you also run the risk of actually losing more than you invest. Those are some of the reasons why you can't do it in an IRA account or 401k, etc. Let's touch down on the mechanics of selling short. So I want to use everyday things that we're familiar with to kind of put it in layman's terms, for lack of better words. Now, let's say a friend lends you a car and you immediately sell that car for $20,000. You're selling something that you don't own. Now, I'm not advocating going out and selling a friend's car, but I just want to give you guys an example in relatable terms. So let's say 2 weeks later, you go out and you buy that exact same car, same mileage, same color, etc., for $15,000, and you return it to your friend. Give him the keys. Here you go. Have a great day. You've profited $5,000 on that car. You sold something you didn't own for $20,000. You went out and you bought it for $15,000. Your profit's going to be that $5,000. Now, on the flip side, let's say that you buy the replacement at $21,000. You have now lost $1,000 on that vehicle. That, in essence, is selling short. If you can understand that concept, you can understand selling short. Of course, it's going to function a little bit different in your brokerage account. You're going to have to be familiar with the terms and order types and things of that nature. But if you can understand that, you can understand the gist of selling short. Now, let's talk about real world and brokerage terms. So in essence, when selling short, you are selling shares you borrowed from your brokerage firm that must be covered at some point in the future, hopefully at a lower price. So let's say you sell short 100 shares of AAPL, being Apple, at $100 per share. This is going to give you $10,000. Let's say that AAPL falls to $90 per share 2 weeks later, and you cover your shares at $90 per share. This will cost you $9,000. You have made $1,000. And if you can catch Apple on a downward move, that's a very realistic trade. Let's talk about some of the risks. You want to be aware that when selling short, you run the risk of losing more than you invest. That's going to be a key concept. A stock can only fall to zero, whereas that stock can rise up to infinity. There's no limit to how high that stock can rise. Now, granted, most stocks aren't going to rise up to infinity. Stocks go up and they go down, but I mean, it's possible. I mean, the stock can keep going up. Brokerage firms will have margin requirements in place to keep you from using too much leverage But in the event that the stock rises very fast or gaps up, the brokerage firm may not be able to force a cover until you've suffered substantial losses. And things like that happen. Let's say Apple comes out with some new revolutionary product, or they report sales numbers that like far exceed what they were anticipating. Stocks can rise up very quickly, and those are things where if you're on the short side and it starts to move up, you can find yourself in trouble very fast. Also, sometimes brokerage firms may not be able to borrow shares anymore, and you may be subject to buy-in, so they can't always maintain a loan in a particular stock, and you could be subject to a buy-in. Let's get into how to set up your order. So I went ahead and I pulled up my brokerage account. I utilize E-Trade just to give you guys an example on how you would set up an order. I went ahead and pulled up Apple just to give you an example of where Apple is. See where Apple's trading. Apple's been doing very well the past year. So I don't know if I would be shorting Apple personally at this point, but I'm not here for advice at this point. I just want to more so give you guys real world examples on how it works and how you would set up your order. So from there, we're going to mouse over trade. We're going to mouse over trade here. Then we're going to click on stocks. Your order type is going to be sell short. Quantity will say 10 shares. Symbol AAPL. Now you have a choice on price type. If you wanted to do at the market, and right now the market's not open, so you're not getting a realistic bid ask on Apple. But the market, you're essentially sending your order to the market, and you're going to sell short at whatever the next best available bid price is. The bid price is what you're looking at when you're selling short. If you wanted to do limit, and you go in and you plug limit here, and you go in and you plug in a limit price, and so let's say 135, you're only going to sell short if the stock is bidding at 135 or higher. If it's bidding less than 135, you're not going to sell short. All right, and then you would do your term, good for the day, we'll use in this example. And then from there, you would preview your order. And that pretty much sums it up. That's selling short in a nutshell. If you have any questions, feel free to reach out. And I hope that I thoroughly covered selling short for you and cleared up any of your concerns that you may have. Have a great day.